Welcome to today's Strategic Source webinar. Today's topic on the screen, it shows trends in the auto retail and the buy-sell market and a few ideas to succeed in the long term. Good to have you joining us today. This is David, the session producer. Our CEO, Doug Austin, will be coming on in just a moment for a few opening comments and then introduce our guest presenter. Audio is via your computer speakers. You can ask questions via the Q&A box that will be appearing in the lower right-hand corner of the screen once we get underway. So let's get underway. Doug, you can now activate your camera. So here now is Doug Austin, CEO of Strategic Source. Doug, it's all yours.
Well, welcome everybody for joining us today. We're excited to bring Alan Haig on to speak a little bit about the buy-sell market. Just before Alan begins, I just wanted to let you know we started this program, the Innovative Supplier Series, in June of this year, and we've run now, I think this is the 13th webinar. We invite highly innovative, highly competitive suppliers, consultants to speak primarily to our client base. The idea is to give them ideas that will help them across various expense categories, audit and recovery categories, and new opportunities to generate top-line revenue. At the end of this, we will post this webinar session on our website, and then and if you're interested in any of the previous sessions that we've done on a various host of topics, you're welcome to look at that as well. But right now, I'm going to turn it back over to Alan, and Alan, we appreciate your time today, and please take it away.
All right, Doug, thank you very much. Nice to be with you today and join this group. I appreciate the kind words. We've got sort of three topics that I wanted to discuss today. One is some trends in auto retail that we see, we've been documenting in terms of margins and profits, et cetera. Also, then, we want to get into the buy-sell market, which is our area of expertise, and share with you what we see going on there and the impact of some of those trends on dealership values. And then, obviously, we have been enjoying robust conditions here the last year and a half. We're starting to see some potential risks that are occurring post-pandemic. And we have some ideas about how dealers could prepare themselves to fight off those risks. So I'm going to start advancing this. I would say that I very much enjoy the Q&A portion of a webinar, and so I hope that at any time you have questions, I think there's an area there on the right side of your screen where you can post questions, and we'll try to get those answered for you. We also have a few polls along the way where I'm trying to get some feedback about your opinions of dealership values, et cetera. So I do hope this will be as interactive as possible, even though I can't see any of your faces. So moving on here, again, Doug's explained about Strategic Source, a little bit of information about our firm. We are basically a buy-sell advisory firm, typically advising sellers on M&A transactions. We focus on auto. We do a little bit in truck and RV. Together, our team has been involved in the purchase or sale of about 540 stores across the country, about $8 billion in dealership value or transaction value, excluding inventories. And we've had the good fortune and honor to represented 19 of the top 150 dealership groups in sales of their companies, or sometimes just selected divestitures. So we're going to get into first trends that are impacting dealership values, and then get into some of these other topics later today. So the big story of the market, which you all know, is that there are almost no vehicles for sale on the new car side. The chart on the left shows some data from Cox that shows that the day supply has dropped down to 34 right now. Pre-pandemic, it was averaging 82. So we have, I don't know, about 40% of the units that we used to have. And, of course, some of these are in transition. They're not even available on dealers' lots. On the used supply, it's better than I think many people assume. Dealers have done a better job sourcing used vehicles. If they don't have a lot full of new, then they're going out and they're buying directly from consumers. They're keeping the lease trade-ins. They're wholesaling fewer vehicles. And so it's just that they have something on the lot for their customers to buy. And, of course, that's one reason why we've seen a big inflation on the used market, just as we have on the new. due to the lack of supply. This chart shows gross profits on new only. This is gross profits for new vehicles sold, including all of the other vehicle income, tax, dock fees, etc. This comes from the publicly traded retailers, the 6 major ones, and it tracks over the last 7 quarters or so the change in front end gross. And you can prior to the pandemic in the fourth quarter of 19, we were about $2,250 a car. Dropped a little bit in the first quarter, probably due to fear in February and March by dealers that had too many vehicles in their lot. They were trying to sell everything. And then it's just exploded. And we're now at $5,300 a car in the third quarter of 2021, more than twice where we were pre-pandemic. So it's just been an incredible elevation in gross profits for dealers. This next chart shows front-end gross plus F&I. The light gray is the F&I component. And you can see at the end of 2019, front and back, dealers are making about $3,800 per new unit sold. Now, when you include F&I, year to date, we're at over $6,000 for front and back. And if you just looked at the third quarter, not year to date, into the third quarter, the numbers would be even higher. So we've seen, as I said before, more than, a huge spike in new, but the F&I numbers have also gone up, partly because the value per vehicle has gone up, right? People are buying more expensive cars and are paying more for them. But also dealers, since they don't have as much volume going through their showrooms, the F&I departments, I think, are doing a better job selling more product and getting more penetration. Because as the volume goes down, those F&I managers have got more time per customer to sell product, and as a result, F&I numbers have gone up nicely. This chart is for used vehicles. This is front and back, and you can see here the bar for 2019, front and back. Dealers are averaging $3,123 a copy. Year to date, third quarter, they were over $4,300. So we've got more than a 50% lift on front-end gross for used and a 22% lift on F&I per unit sold. So just a fantastic job by the dealers. It's one of the beauties of our dealer network is that, or really our industry is that, if supply drops, you simply raise prices to offset that so long as the demand is there. And given all the stimulus and other pandemic effects, obviously dealers are seeing very strong demand for vehicles right now. So we talked about new, we talked about used. I don't have the fixed operations data with me today, but it's also up. It dipped during the pandemic because people were staying home and driving less. But now people are driving again, and the F&I numbers have gone up. Some of that is just miles driven, but some of it is also we're seeing a number of our clients apply, fight for, and receive big increases in their labor rates. So for those of you that are involved in, applying for labor rate increases, I mean, we see dealers now. I was on the phone yesterday with a dealer who is getting $280 per hour for warranty work in one of his luxury stores and over $300 in another one. And these numbers are significantly elevated from where they were just 12 or 18 months ago. So he's been able to show the manufacturer what he's paying, what he's charging for customer pay, and he's winning these battles and doing quite well on the fixed ops. But this chart shows the cumulative effect of higher new vehicle gross profits, higher used vehicle gross profits, higher F&I, higher fixed, and lower expenses. And you can see here that the profits per rooftop, now this is NADA data, so these are privately owned dealerships, not the public ones, which are typically larger. But the average privately owned dealership is making over $3 million per year right now. That excludes PPP. If we included PPP, it'd be about another 300,000 or so. So it's just been an explosion of profit. It's a perfect storm for dealers right now where there's a lot of demand, there's so much money in people's pockets. The inventory is limited. So it's a seller's market, if you will. If you're the dealer, you're able to charge what the market will bear, And right now, that's yielding just a massive increase in profits, more than doubled since pre-pandemic times. I have a dealer friend of mine who said that they no longer count the money, they just weigh it, which hopefully is what you all are doing here at the end of the year as well. So here we got our first poll. Very curious to get people's opinions here. This has to do with the timing of the market and how much longer do you think that we will be enjoying the same level of profits as we are today? All right. It looks like the numbers are still coming in. I'll give it another few moments. Okay, so if we, which ended here, it looks to me as though we've got 63% of respondents believe that we have at least 9 months of good times, and quarter people think that it's 12 months, or I guess we should say 12 months or greater. And honestly, every time we talk to people at the factories or dealers that have a number of factories, it appears that this shortage is going to go on well into 2022 and maybe even in future years, because the production capacity of the manufacturers is relatively fixed. It's not easy for them to expand. If we've had 3 million, 4 million units over the last 2 years deficit in terms of new vehicle sales, I don't know how they're going to catch that up in any quick way. So we're hopeful that that this poll is correct. Next topic we want to get into is what we're seeing in terms of M&A. And, when dealership profits are flat, it's fairly straightforward for us to estimate the value of a dealership. There's a lot of data that we have, and of course we poll. We talk to the leading buyers, we talk to accountants, we talk to lawyers, CPA firms that are involved in M&A to get a sense of what multiples people are paying for dealerships. That's become a lot harder when the profits have more than doubled, right? They're like 2.5 times what they were before. And so because people believe that the inventory situation will eventually be remedied and the gross profits will go down, people believe that the profits will go down. How far, we don't know. But as a result, I think buyers have been struggling to try to figure out, if I buy a store today and I only get the future profits, not the historical profits, and I want to get the same return on investment as I have in the past when buying a dealership, how do I value the store? And one way that we've seen buyers be comfortable is taking an average of pre-pandemic profits and include in there a period of current profits, because if profits are going to be the same in 22 as they were in 2021, you can't just use the old pre-pandemic numbers to buy a store because people won't sell. So a formula that we've seen buyers use is taking 2 years of pre-pandemic profits, so let's call it 18 and 19, and then include the last 12-month period. And you create a 3-year average that's based 2/3 pre-pandemic, 1/3 pandemic. Now, we're beginning to sense that this formula might be a little bit light because we've gotten a couple offers come in on some groups we're selling where it looks to us as though dealers are more confident about the future profits of this business. But at any rate, this is a formula that we have seen dealers use when acquiring stores. But it's just one formula, and ultimately the buyer is going to determine how much they want to offer. We've seen all this cash come into dealers' hands. Many dealers have used it to pay down floor plan, pay off mortgages. They're now, got cash just stacking up in their checking account effectively. And I think many of them are going to put it to work acquiring dealerships, and they may accept a lower return on investment on acquisitions than they have in the past because there's simply no other place they can put their cash. They're so de-levered right now. But at any rate, this formula is one that's worked, I would say, in the second quarter and a little bit in the third. I'm not sure if it's going to hold in the fourth and going into next year. So we talked in the previous slide about average earnings, which might reflect the next 3 years of profits. This chart shows our estimate for the blue sky multiples that buyers would pay for these franchises in a competitive marketing process. meaning I'm not just the only guy at the table. There are multiple people bidding on a business. And you can see still on the left side of the page, the highest multiples are being paid for the premium luxury brands. You know, there are fewer Porsche stores than there are Chrysler stores, for instance. They're also perceived as a little bit easier to run, and there's certainly a prestigious element to owning a Porsche store in town if you're fortunate enough to be able to get one. So then that steps down into kind of the next tier of franchises, which includes a couple of luxury brands like JLR and Audi, but also Honda, Toyota, and Subaru has really elevated itself the last, well, they've been on a tear for about 8 years, but the last 2 or 3 years, I think a lot of buyers have woken up that they need to have this brand in their group to have a really diversified franchise. The product has been perfect for many people in the market in terms of, you know, affordable CUVs. And I think people also really like the business model, which even pre-pandemic was, you know, one less Subaru than what the market wanted. So the cars sold quickly, the factory had good relations with dealers, and sales were booming pre-pandemic. So after that group, we kind of dropped down to the third tier where the multiples don't range that much. They're typically in the 4 to 5 times range. Some on the right side of the page, Acura, Mazda, Volkswagen, those are more in the 3 to 4 times range. And then on the right side of the page are a couple of brands that pre-pandemic really weren't very profitable. Post-pandemic, you know, they are just because of the margins. But we're seeing those trade not so much on a multiple of earnings, but more just on a dollar value. The darker blue bars reflect where we've made a change in blue sky valuations, and you'll see we've increased our numbers on Kia and Hyundai. Those brands have come out with really attractively styled products, lots of new crossovers. For Telluride and the Telluride model and the Palisade model have been huge hits for dealers, and we see long waiting lists for those products. So we're impressed with the performance of those brands because of these high-priced SUVs. They're bringing in, I would say, a higher income customer than what those brands have attracted in the past, and we think those customers are likely to do more service work at the dealerships as well. So we've elevated those two brands. You'll see Nissan. We've also boosted Nissan up. Even before the pandemic hit, I think Nissan had realized the error of its ways and being too much of a push system and trying to increase market share and creating an incredibly brittle situation where residual values were bad, dealers were unhappy, they were playing favorites between dealers in terms of what the stair-step programs were. And so a lot of buyers simply walked away from this franchise. They did not want to buy it, and if they had it, they wanted to sell it. So the value got pushed down very far on Nissan. Now I'm seeing they've got some fresh product. The Pathfinder is a very hot product, the Rogue, Kicks, and Judy Wheeler and the other sales executives there, I think, are making the rounds of dealers and trying to mend fences and get people excited about being Nissan dealers again. So this, to us, is probably the value franchise, if you will. It may never reach Honda or Toyota. It never has. But if you can buy a Nissan store for 3 or 4 times, you know, that's 50% of the blue sky what you're going to pay for Honda, and probably even less than what you pay for Toyota for the same amount of earnings. Now, these multiples are our estimates. Every deal has its own variables that drive value. You can see in some cases we see stores trade for more than what we estimate. That's the blue side of the page here, meaning that if a dealership is perceived as underperforming, people may pay a higher multiple than what we state for that franchise. Typically, stores in metro markets are higher multiple. States like Florida or Texas with no income tax, those bring higher multiples as well. And then there's some reasons why somebody might pay a lower multiple than what we quote, and those are on the red side here. You know, if they're not marketed properly, if they have facility issues, if they're in rural areas, if you're in a really high tax market, then a buyer has to pay, or typically will pay less for that franchise to get the same amount of after-tax cash flow and after-tax return. So when we factor together the average earnings that we talked about a couple slides ago and then the average blue sky multiple, we come up with the average blue sky value per rooftop in this country. And this chart shows that back in 2010, coming out of the Great Recession, the average dealership had about $3.4 million in goodwill. Some of that was lower multiples, but most of it was just a lot lower earnings. The stores just weren't making that much money back then. Now fast forward to 2019, you can see blue sky values averaged $6.7 million per rooftop, so double what they were a decade before. And then look at 2020, where we had some pandemic effect with higher earnings and a little bit higher multiples, taking us to 8.1, which at that point was the highest number we'd ever recorded in terms of average blue sky values. And sitting here today, trailing 12 months, we're at $10.9 million for goodwill. So almost tripling what the goodwill value was back 10, 11 years ago. So just a huge run-up in the value of these franchises, which is wonderful for sellers. For buyers, it's creating some angst with it because they're maybe wondering, do I really want to buy when prices are this high? And, we just see buyers making the decision to do that because it's still a better return on investment than what they can get by paying down debt or investing in commercial real estate or investing in the stock market. I think there's optimism that these good things are going to continue. It's just for folks in our business, we're selling stores. This is like a dream come true to be able to sell an asset for 3 times what it was worth 10 years ago. And I think there's a good chance, values are going to continue to increase if these cash flows continue to increase as well. So now we've got our second poll, which has to do with value. The question there is, do you think dealerships will be more valuable after the chipdemic, which is what we call the shortage of microchips, than they were before the pandemic began? So in the end, when all this shakes out, are dealerships going to be worth more money than they were before we had this pandemic effect? So it looks like we've kind of stabilized here, and as I read these numbers, roughly 2/3 of the people who responded believe that dealerships are going to be worth more in the future than they were in the past. And honestly, that sort of meets our expectations as well. Part of it is I think we're going to have this inventory shortage for years and years and years. But I think also that during the pandemic, dealers have built new muscles. They've developed new strengths. Part of it is on the used side. I think dealers have realized that you can make a lot of money on the used, and every used car you buy, you run through the shop and recondition. So it's good for your fixed ops. Given the big elevation in new vehicle prices, it provides a much better alternative for customers to be able to afford a car. And so they're buying cars directly from consumers. They're wholesaling few of them. They're just better retailers. Same thing on the on the F&I. I think that dealers, when you have fewer cars to sell, you focus more on each one, and they've developed better skills on the F&I office. And I think also the third thing might be lower expenses. I know we have some CFOs on the line, and I would bet that 90% of you are operating with fewer people than you did pre-pandemic, even though you're making more than twice as much money. So people have found a way either through digital marketing or other efficiencies to be able to operate with lower costs. So now let's go on. We talked about conditions in auto retail. We talked about the M&A market. Let's talk a little bit, or dealership values. Let's talk a little bit about what we see happening with consolidation right now. So this chart shows the number of rooftops acquired over the last 10 years or so. The blue portion of each of those bars is the number of stores acquired by a privately owned dealership group. And the red portion shows the dealerships acquired by publicly traded companies, so AutoNation, Penske, Lithia, et cetera. And you can see that, up until really 2020, typically public companies weren't really growing that much. They were really divesting about as many as they were buying. It was kind of status quo. AutoNation was the biggest retailer, but they just spent almost all their money buying back stock. The other publicly traded retailers were also pretty modest in their acquisition activity. They were working on other initiatives. But Lithia, starting in really 2019, 2020, began to hit the gas in terms of its acquisition plans, and it came up with a strategy to get to $50 billion in revenue in 5 years. And you can see the impact of that happening beginning in 2020, but then accelerating in 2020, beginning in 19, but then accelerating in 20, and then in 2021, we've seen a massive increase in the number of rooftops that have been acquired, and it looks to us like there's going to be almost 230 rooftops acquired by the publicly traded companies in 2021. That compares to like 25 or 30 per year pre-pandemic. So 10 times as many stores acquired in 2021 as they were pre-pandemic. And I think that's Lithia, that's really aggressive, and they're being very successful in their acquisitions where they're buying stores and finding a way to add value. But also, you know, if you're the CEOs at the other publicly traded companies and you see what's going on over at Lithia and you see how excited the investors are, I think you start to realize, like, you know, I got to start growing again. I can't just sit here and clip coupons. I need to show that I'm adding value and my company's growing and healthy. So we've seen AutoNation do 2 large deals this year. Sonic did a large transaction that they hadn't really bought many stores in the last decade. They've been focused on Echo Park. Group 1 just bought a large company up in New England. So really, all of them were active. Asbury's been very active the last 2 years, buying stores in Texas and West Coast and other places. So really, all of them have gotten very active, and we still feel like that's going to continue well into 2022 and hopefully beyond. You'll see a modest increase in the acquisition by private dealers, you know, going from 300 to 340 or so. So still an increase, but 10-15% as opposed to, you know, 400%. This chart shows the amount of money being spent by the publicly traded companies. In the last chart we showed how they're buying so many more stores now. So the blue portion of these bars each of these years is the amount of money that the publicly traded retailers spend on buying stores in the U.S. The red portion of the bar shows what they spend abroad or on heavy truck in the U.S. in the case of Penske. So you'll see for 5 years prior to the pandemic, they were spending $500 million to $1 billion a year acquiring U.S. auto franchises. Fast forward to 2020, you had a massive increase, and then in 2021, it looks to us as though there's going to be $8 billion spent by the public retailers on acquiring U.S. auto dealerships. So 10 times the amount that they were spending before the pandemic. So just an incredible explosion of spending, and that's one reason why you're seeing some very large groups exit right now, because there's an enormous amount of capital that the public companies are willing to deploy in acquisitions right now. So, you know, if you say, well, who's the smart money in this business, you'd have to think that the publicly traded retailers have got a lot of access to data, forecasts, et cetera. And they are shoving their chips in terms of all their cash. They're out raising additional funds through equity offerings or debt offerings to fund these acquisitions. And of course, they have record profits as well that they're using to fund these acquisitions. So I don't think this is going to be just a one-year anomaly. They're going to spend $8 billion and next year go back to spending $500 million or $700 million. I think we're going to continue to see escalated spending in 2022 and beyond. Maybe not $8 billion per year for those next couple of years, but certainly well above where we have been prior to the pandemic. So we've had just incredible activity in terms of dealership profits, and now incredible activity in terms of spending on dealerships. So talked about all these wonderful conditions for dealers right now, record profits, record dealership valuations, and so we could be content to go into the holiday season and put our feet up and just enjoy the fruits of our labors, and sometimes the fruits of labors we didn't work that hard to get, right? It's just the market brought it to us. But we still see risks out there that won't be felt this year or next, but in future years we think they may. So just a few of them. This is a list of 5 risks that, were existing prior to the pandemic. And, some of them have proven not to be really viable. Like we would say ride sharing. The pandemic has made people realize, I want to have my own car. I don't really want to ride around the back of some stranger's car with a cloth mask on that, just had it off right before I got in the vehicle. Another risk that we don't really see viable anymore is autonomous vehicles. There was a lot of fear that people would stop buying a car or just press a button on their phone when they wanted to ride somewhere, and one car could service 3 or 4 people in a household. But the technology is too far away, I think, to that be a viable threat. But the other threats are still real. New entrants, and by that we mean Tesla and most recently Rivian, Lucid, et cetera. Electrification. For years we've been talking about electric vehicles. They're still less than 3% of the market, but many of the new product launches that are happening are EVs, and the federal government, it seems, very focused on getting people out of internal combustion engines, and a big part of the stimulus bill is to pay for charging infrastructure. And then also consumers during the pandemic have changed, and I don't think that they're going to go back to spending 5 hours negotiating a car to go in a showroom. They've gotten very comfortable ordering products online and having them delivered, in a hassle-free process. So this chart talks about a little bit how the pandemic affected consumer behavior, and that, traditional retail is having to adopt or die. And we see here at the bottom, 12,000 chain locations closed last year and are not going to reopen, many of them anyways. The restaurants may come back, but a lot of people have shifted to online shopping. And so I think, what the pandemic proved is that there was questions, hey, would people ever buy a used car online, and Carvana started to do that, and maybe that was just the early adapter crowd. But now we have people spending $300,000, $500,000, $1 million sight unseen on a house. They just look at the pictures. They trust that they're accurate and properly disclosed. Certainly people we know are willing to spend $15,000, $20,000, $30,000, $40,000 on a used car online. And now retailers are seeing that they're willing to spend $50,000, $60,000, $70,000 on a new car online. So things have changed from the consumer standpoint, and dealers are going to have to adapt. The 2 leaders that we track right now in auto retail are Carvana on the used car side and Lithia on the franchise side. If we start with Carvana, there were a lot of doubters about this company. This chart shows the number of used units that they've sold over the last 6 years or so, and their growth is really impressive. In a market where used cars are very hard to come by, they've sold 82% more used units year-to-date 2021 than they did year-to-date 2020. Very few companies in auto retail are growing 82% a year in terms of top line. Revenue, it's even more. Now, some of that's because of the run-up in vehicle prices, but they grew 141% in terms of revenue year over year in terms of first 9 months of the year compared to the first 9 months of last year. Gross profit per unit, selling more, making more per unit. So, right now it's hard to look at something Carvana is doing and not be impressed by what they're up to. This chart shows EBITDA net profit margin. You see it's taken a dip in the third quarter, but this company used to be unprofitable. Now they're making profits, and a lot of their profits could go up more if they chose to focus on profits as opposed to growth. But they're continuing to invest and open up new or more inspection centers, distribution, and spending heavily on advertising. The Carvana experience, this comes from their website. Here's some data that I think all of us should be aware of. 86% of customers, are searching online first. They're not going to showrooms. 61% of people would consider purchasing a car online. 2 years ago, no way it was this high. And a lot of people, only drive one vehicle when they're testing a car. So they're not going from dealership to dealership. They're really spending most of their time shopping when they're online. When they come to your showroom, they're ready to buy. Or when they come to Carvana's website, they're ready to buy. So dealers aren't even giving a chance to sell to some of these customers. Here's the process. I really encourage you to go online to the Carvana website. In my opinion, it's easily the best that I've seen of any auto retailer in terms of how easy it is to search for vehicles, the information they provide. They've got, in many cases, a digital Monroney sticker, so you can see exactly how a vehicle was built, what the price of the options were, what's included in the option package, and just gives a lot more information than a traditional dealer blurb. So when you give consumers more information about something, they're more likely to pay more for it. Now, let's talk about the customer experience. If this is their ratings, now I know online ratings are, who knows if they're really accurate, but we've not seen many dealerships that have a 4.7, stars when you look at how they're rated by consumers. 96% would recommend it to a friend. I think we would be thrilled if auto retailers could be in the 70s or 80s. So what this implies to me is, the customers are happy, they're telling their friends, and so I think Carvana's market share is likely to continue to grow. Here's a chart that shows the stock price for Carvana. That's on the left side there. And in the right-hand side, there's a bar chart that shows the market capitalization, so the value of Carvana's equity. And you can see it's more than double what CarMax's market capitalization is, and well higher than the combined market capitalizations of all of the publicly traded auto retailers. So Carvana's the baby, right? They're the newest company out here that's of any real size. You have Vroom out there as well and some others, but they've only been around for, I don't even think, 10 years, and they've already seized the honor, the privilege, the reward of being the highest valued company in our space. Let's talk about Lithia. That's the closest parallel that all of us can identify with best. It's a traditional dealership group, sells new cars, used, F&I, et cetera. They have a plan to generate $50 billion in revenue by 2025. I think at the time they announced this, they were just doing a few billion revenue, so it was a massive expansion, and they're on track. They're actually ahead of schedule to hit this $50 billion. Their goal is to buy dealerships across the country, a mixture, domestic, import, luxury. They want to be within 150 miles of every consumer in the country. And then rather than keep on buying stores to satisfy customers that are further away, they're planning on using their app, their Driveway app, to sell and serve those customers that are further away. Now, this app, again, I encourage you to go to it as well. They've invested, according to what they said in their public filings, more than $75 million to build this app. They've got 110 software engineers that are developing this user interface that connects with their inventories, et cetera. And they're on track to sell 15,000 cars through this app this year. So demonstrating that even traditional retailers can penetrate the digital marketplace and serve customers who want to buy digitally. Today it's a small fraction. The last car I bought, I went to the dealership and made an offer and left when they wouldn't take my price and came back. But my kids are not going to do that. My kids are going to pick up a phone, here we go, and they're going to press buttons to get a ride. They're going to lease it, they're going to rent it, they're going to buy it, they're going to trade it in, they're going to get financing, they're going to press a button to get the car serviced. And I expect that your children are probably the same way. They're accustomed to digital commerce, and that's what they're going to want to do going forward in many cases. Now, there'll be other customers who really want to come to the showroom and smell the car and touch the car and see options. And so I'm confident that traditional retailers have an advantage over the Carvanas who don't have a physical footprint. In my opinion, it's an advantage to be there, particularly for service. So I point to Lithia as a leader that many of us can emulate. When I say many of us, many dealership groups can emulate by not just grudgingly going towards e-commerce, but rushing towards it to try to become a leader in your area in terms of e-commerce. Build your brand, get your customers trained to that, and create a sticky, positive experience that allow you to keep those customers going forward and not lose them to a Carvana or another larger retailer. Lithia's My Driveway, if you go online, here's the benefits of scale. We talked about consolidation and what it means. So the larger groups, I mean, Lithia's got 57,000 cars that you can purchase through their website. An average dealer's got 2 stores, probably has 400 cars, 300 cars he could offer to a customer, new and used. Negotiation-free pricing, instant financing. I pulled some information off of the filing. Some people don't know that Lithia has their own finance company now, but they've written loans, $534 million worth of loans through September of this year. Their monthly originations, this is publicly traded data. I don't know if you can really see it, it's so bright. But those bars, that shows every month they're writing more and more paper to their customers. And so they have another lever that they can use when trying to sell a car to a customer is on the financing side. Maybe they'll take a little bit lower front-end gross in order to get that vehicle financed. That's something that's difficult for traditional dealers to do. You can see the other consumer-facing offers that Lithia has through My Driveway. And you have to ask yourself if there's a Lithia store that shows up in your market and they have this available online in an app, are some of your customers going to gravitate towards Lithia and away from you? And if so, what can you do about it? Here's their market capitalization. You can see that, for a while prior to Lithia really accelerating their grand acquisition plan, their stock price traded between $75 and $150 a share. But once they started acquiring dealerships, the market really rewarded them. And now they're trading for $325 a share. So Brian DeVore has done a terrific job of growing this company in a way that's profitable and providing orders. Now another risk. So we talked about consolidators, that we think larger groups are going to use greater inventories, greater convenience, greater technology to slowly try to take share away from the mom and pops. There's a research analyst at Morgan Stanley that published a report just a couple weeks ago that caused the stock prices of the traditional auto retailers to drop. And there were two reasons. One reason was this one, internal combustion engines versus electric vehicles. Now, in this analyst's opinion, internal combustion engines are going to be shrinking and EVs are going to be growing. Not a big shock, right? We all sort of assume that happens. But he's predicting next 9 years that it's going to be a massive shift, and it would be like 40% of the volume of the electric vehicles. Now that could have a very negative impact on the service departments. We don't know that yet. I'm hoping that internal combustion engines, which today customers sort of stop servicing them at dealers after 3 or 4 years when they go into the independent shop. If you have an EV, maybe you bring it back 5, 6, 8, 10 years in the future because it's more complicated. That's my hope, so we won't lose on the service side. But this, to me, is potentially a greater risk. This is the market share or the sales for existing dealers versus new entrants. New entrants include Tesla, Rivian, and others. And this analyst has done some projections that show that franchise dealers are going to be selling fewer and fewer units every year as those sales are taken by new entrants. And I really have been a skeptic about Tesla for years, but if you talk to dealers in California, particularly luxury dealers, they will tell you that Tesla is the #1 brand in almost every single census tract in that state. There are a few places where there's some rock star dealers like Fletcher Jones Mercedes and Newport Beach where Mercedes is still the #1 share, but almost everywhere else it's Tesla that's taken the #1 position. So they are now building a plant in Texas, and they're going to be producing the Cybertruck there. They have 1.25 million orders for that truck. The truck, to me, is styled crazy. I don't think I'd like to own it, but 1.25 million people disagree with me, and they put down a deposit. Now, Ford, is producing electric trucks, and General Motors will be as well. So I hope that these projections are wrong, and that the franchise market is not going to have a negative projected growth rate of 2.4% per year for the next decade. But at least one smart equity analyst believes that that's what's in our future. So these are some fears that we have that could negatively impact franchise dealers, which is our customer base, and very important for us to try to make sure that franchise retailers stay healthy. So we think there are a few things that dealers can do to protect themselves against these threats. One is get bigger. You know, if you have 1 or 2 stores, it may be very difficult for you to compete long-term with the Lithias or the AutoNations or the Carvanas that are going to combine their inventory across their whole chain and deliver it directly to your customer's driveway. So if you have 8, 10 local stores, you probably have as many units available for that customer to see in the market as an out-of-town retailer would. And then they can come and see them in person, and you can service them. Build a diversified group. So if you have a Ford and a Chevy, buy a Honda, buy a Mercedes. You know, don't have 5 Ford stores in town. That to me seems like a dangerous strategy. Build a local brand that has roots in the community. We still think that talent and service trumps technology in our industry. So contribute, you know, to the State Dealer Associates, contribute to the Little League teams, provide a car to the fire department, you know, make sure that those customers know that you care about them and you're not a faceless giant company that, you know, trades on the New York Stock Exchange, you know, shop local. And the last is about talent. We have a friend, Don Flo, who some of you may know, who's a dealer in Central Park, North Carolina, and he and his family have really made a big effort to try to attract talented young people into the industry, and they recruit kids out of many local colleges. They lay out a career path for those newly minted students where they're going to rotate into different positions in different stores and eventually end up running a dealership, which these days is a $75 million plus enterprise. So it's a very sizable company, and they believe by having the best talent locally and with scale locally, they're going to be in a better position to gain market share versus a national retailer like a Lithia or Carvana or somebody else. The other part here too, and I'm sorry, it looks like this slide is, maybe we can show it here. We have a friend, Brian Benstock, who is the vice president at Paragon Honda and Acura in Queens, New York. And some of you may know him. Unfortunately, we have this slide, which I thought we could have animated, and maybe it is animated, but you can see here a map of the New York City area. The stores that Brian runs are in Queens, which are kind of the west side of Long Island, east of Manhattan. And they were offered an ad point, a Honda ad point in Manhattan. And Brian and his team turned it down. And they said, let us show you that we can serve Manhattan with pickup and delivery for sales and service. We don't want more bricks and mortar. We don't want more expense, et cetera. So let us just demonstrate this to you. So they developed apps, you know, text for service, text for pickup. They were able to learn how to communicate with customers easily in Manhattan, which is one of the hardest places, you know, logistically to operate. And they were, and I see the arrow moving around there, so we have an animated slide, but I'm not sure if it's going to work today. But if it were working, you would see that over the last 2 years, they have picked up and dropped off thousands and thousands of cars in their market. And this is the hardest market in the country to get around. And so they've been able to significantly expand their business, not through new bricks and mortar, but through pickup and delivery for sales and service. And it's just been the best example I know of somebody who's an average dealer, meaning he has 2 stores, but no lack of ambition in terms of growing, and didn't use a lot of capital by buying more stores to grow. But if you can imagine this map that's mostly white, filling up with green dots all over the island of Manhattan, much of the western part of Long Island, even over into New Jersey where they were picking up and dropping off cars. it's a phenomenal success story. And there are a number of vendors that help Brian. He didn't do it by himself, Red Cap and others. And I'd be happy to connect you with them if you want. But that to us is an example of a typical dealer able to respond to changing environment, meaning consumers' expectations, to outperform and provide a better customer experience than what was available before. And I don't think he's going to lose share to Carvana or Lithia whenever they come to his market, because he's already doing it. I don't know if we can go back to the original presentation now. I think we're just about done anyway. Okay, so this chart shows that not only did Brian build a lot more business through pickup and drop off of sales or for service, but this is showing his average RO. Before he was picking up, his average RO was $283. When he did the pickup, it jumped to more than double, $600 per RO, because when a customer is in the waiting area and you come to them and say, well, I finished the oil change and the tire rotation, but it looks like your brake pads are low. They say how much and how long, and then many of them don't want to wait any longer, so they just leave and say, I'll do it next time. But if you picked up their vehicle and you've taken it away, they're at work, and you text them and say, we finished with what you wanted, but we identified some other work that needs to be done, and would you like us to do it? Click Y, for yes. A lot of people are sitting in their office. It's not any more inconvenient for them, so they just says, yes, please, take care of that. It's one less thing I have to worry about the next time. And so they're doing more work by picking up and delivery, and that helps to pay for the additional expense. So, all right, I think this is our last poll here. Given what the analysts are saying, how concerned are you about potential impacts to your profitability from new entrants like Rivian, et cetera, or just the shift towards EVs and the impact it could have on your service department? So, how significant are these risks in your opinion? Okay, looks like most people have voted. So, this looks to me like people have real concerns. So as good as the conditions are right now, record profits, record blue sky values, in sight in terms of the good times, at least I shouldn't say no in sight, but in the short term, it looks to me like the large majority of people, let's call it an average of 7 out of 10, are pretty concerned that these trends, consolidation, technology, new entrants, electrification, are going to have or a threat to dealers, and hopefully folks will respond some of the ways that we suggested or other ways that will help them to maintain their profits. So I've been chatting for a long time here. Maybe we should do a little Q&A. Okay, I see, David, are you asking the questions, or I see some on my screen? Should I go ahead?
Yeah, I see that some have arrived. Let me change the function here, and we'll get ready for some Q&A. The Q&A box now is on the left side of the screen for people to type in questions. And here we go. Here's one. Are the estimated blue sky values for public or all dealerships?
Those are for, we took the average profitability for privately owned dealerships. This comes from NADA data. And then we applied our average blue sky multiple to come up with the average blue sky value. So that's for an average privately owned dealership. Most, I would say the public skew towards larger stores. They just do better with bigger stores. And so their dealership values are probably even higher.
All right, here's another. Do you believe that single point or smaller groups will be dinosaurs? Should they strongly consider selling now, or hold on for a few more years if they don't need to retire in the near term?
But I think that these trends that we talk about are not going to happen in the next 1 or 2 or 3 years. They're going to have an impact down the road. So we see single-point dealers around the country performing really well and probably will for some time. The question is, it could be a little bit like a game of musical chairs where the music's playing, we're walking around having fun. But if you have, let's say you have one Ford store and you're in a metro market, and you have 2 or 3 big consolidators in your market, and they all have these apps, and they're going to be marketing to your customers, I think there's a chance that you slowly lose market share to those people when they develop those capabilities, and that your value slowly declines, and that people don't need to buy your store. They already have a Ford store in town. They have their app. They're selling digitally. And so the question is, your profits may slowly decline, but the value of your store may decline much faster. So we're not alarmists, and we're not saying the sky is falling, but the smallest dealers that are based in metro markets, those are the ones that we think are most likely to be hurt by this shift and this impacting consolidation. If you're a single-point Toyota dealer in a good area that's growing, it's going to be hard to take your share, I think. If you're a Mercedes dealer, even in a metro market, it's going to be hard to take your share. But the brands that have lots and lots of locations that are in competitive markets, those are the ones that we think could have difficulty if they don't grow and offer more choice for customers, more technology, and more career options for people to enter the company and stay there. If you just have 1 or 2 stores, and let's say I'm a service writer and I want to be a service manager, and there's only one guy in the company that does that, if I get a call from another dealership group that has 10 or 20 or 30 stores, I might perceive that as having more career opportunities for me, and I might take that call and I might go work there. So it's, what's best for the consumer. It's also, fighting for talent in our business.
Again, enter any questions for Alan via the Q&A box in the lower left for all attendees. Here's another. Are you seeing more buyers looking at Nissan franchise as a good investment today?
We had a period of time where nobody wanted that franchise. A lot of people were sellers, and they were just so upset with the Carlos Ghosn administration. I'll just describe it that way. But we did sell a couple of Nissan stores in California earlier this year, and we had reasonable demand for those. Since then, I'd say the demand has gotten stronger, and I think people believe that the stair-steps are gone for the foreseeable future. The Nissan product is good. Customers like it. It's reliable. It's well-styled. It's got good features. And the Blue Sky multiples are lower because a lot of people were sellers. So I think it as a bargain opportunity today, and demand is definitely higher than it was even 3 months ago.
Okay. Well, this is Doug. Alan, I appreciate a very, very informative session. I think I've got 2 pages of notes here myself, which is probably more than any other session I've had so far. So outstanding job. Copies of the webinar presentation, and I saw a slide come in on that, are available today. We'll send an email to us at sales@strategicsource.com, or you can text 612-386-3898 and just ask for the presentation. We'll get that to you right away. We will also put a copy of the webinar that Alan did up on our website, and we can make that available to you as well. Thank you so much for attending. Alan, thank you for your time today and for the great information. I know you're a busy guy, and we appreciate you stopping to take time to talk to our folks. David, you've got a survey. Go ahead, Alan.
Yeah, I was going to say that, a lot of this, really all the data plus more, we publish in our quarterly report, Haig report, and the third quarter is available on our website. So if you're a data junkie and you want more facts, you can get it from there as well as through Doug. So thank you for inviting me to join you all today. It's been a pleasure. I'm getting sunburned right now sitting in my window here in South Florida, so time for me to log off probably.
And I can endorse the Haig report. I use that for research for our clients on the expense side as well, so it's a great tool. David, you want to conclude for us?
Absolutely. Thanks, Alan. Thanks, Doug. And thanks, everyone, for attending today. We did bring up a post-session survey slide on the screen. We'd love to get your feedback on the time spent today. We appreciate everyone's time, and we look forward to you joining us on future webinars with Strategic Source. Have a great rest of the week, everyone.